have stocks and bond markets put in their bottoms despite what has been a very strange response to U.S. jobs data and an even stranger and more tragic week end here for the geopolitical landscape. Welcome to Macro Money. It does look like we are witnessing turning points all across the financial markets here. So what we're going to do is take a look at what the macro forces look like shaping things for the coming week and see if we can make sense of what all is going on here. As ever, this is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And without further ado, because certainly there is a ton to look at here, we'll jump right in. The story begins really with Friday's non-farm payrolls number and the overall jobs report as well, and continues as we start this week. And the first thing really that immediately jumps out is just the baseline performance for the S&P 500. So there you can see is the jobs report response. So as we went into it, the markets were showing very clearly what the baseline trajectory here was, or at least the dynamics by which that trajectory would be established. All through last week, there was a stream of labor market data leading into this release. We got jobless claims data. We got the ADP estimate of the private sector's payrolls growth dynamic. We got the ISM surveys with their employment components that tell us how employment growth in manufacturing and the service sectors are doing, which of course make up the lion's share of the whole economy. We got the JOLTS job openings numbers as well. All of them gave a very clear good news is bad news type of a response. When it looked like the numbers were pointing to a stronger labor market, stocks didn't like it, the dollar rose, and vice versa. When the news was bad, such as with the ADP report, which was a bit of a standout, everything else was very tilted toward a positive surprise, we got stocks supportive, dollar on the back foot. And that, of course, makes sense. The markets have been primarily animated in recent weeks by the idea that the Fed is going to hold interest rates higher for longer, that this is a significant weakening of the global economy's defenses at a time when the Eurozone is probably already in recession, and China might as well be in one because it cannot seem to restart its economy in any kind of meaningful way since reopening from COVID restrictions in December of last year. So between those two and the U.S. economy, we have the three main pillars of global economic growth. Two of them already looked dire, and the Fed was seemingly taking aim at slowing the latter even more than they already have. The roundup of global PMI numbers that we got last week for September suggested global growth is already at near standstill. And so the market's perspective on U.S. job data was the more the U.S. labor market stays resilient, the longer the Fed will hold rates higher, the more it will undermine the ability of the U.S. to offset weakness in Europe and in China, the greater the risk of a global recession. So strong U.S. labor data, bad for stocks, is how that basically boiled down. And for about an hour, that was the response that we got when, in fact, all of the good leading data proved to be correct. And the U.S. economy delivered 336,000 jobs in September against an estimate of 170. What's more, the 2 months before, August and July, were revised higher by a cumulative 119,000 jobs on top of that. So when we add this up together, we're approaching something close to 500,000 jobs that appeared on the rolls as of the data that we saw on Friday that were not there before that data. And so, not surprisingly, the market said, oh, well, this probably means the Fed doesn't have to cut relatively soon. This might see them be delayed. Stocks lower, dollar higher. And again, it held for about an hour, maybe about two. And then, as you can see here, there was a brisk and sharp reversal. Stocks bottomed, they turned around, they erased all of those losses, and ended up closing the day with an impressively strong advance. The strongest one-day gain in a month, as a matter of fact. That seemed to send a very clear signal. It seemed to say, we know what you're expecting. We know how we've been behaving. Here it is. Now, here is a very pointed reversal of that dynamic. Unmistakable. Watch us go. Now, of course, this is only one day of price action. It requires confirmation. So we look forward. And what we see is we got a weekly open with a gap down. Not surprising. The news out of the Middle East over the weekend has been absolutely horrific. And so, not surprisingly, the markets have responded with the expectation that the conflict might have scope for contagion, might have scope to balloon into something other than what it's already been. And so gold prices gapped higher, bonds gapped higher, dollar gapped higher, yen gapped higher. All of the traditional sort of anti-risk vehicles gapped higher at the open. Stocks gapped lower, as did most currencies against the dollar, save for the yen, itself a risk-off animal. Yields, obviously, lower as bonds gapped higher. As we go into the close here, that gap has been closed and stocks are on pace to close even higher than they did on Friday. So for the moment, it appears that the market has shrugged geopolitical risk off, for the most part. Gold is still holding on to its gains. That's not terribly surprising here. Bonds are as well, probably for analogous reasons. The dollar is, for the most part, steady. It's a little bit higher against some things and lower against others, lower against many more things, as a matter of fact. There's probably not a breakout against the euro. There's probably not a breakout against the pound quite yet, but it is suffering some meaningful losses against risk-sensitive currencies like the Australian dollar, which probably echoes what we're seeing in stocks. And so the geopolitical aspect of this seems to be, for now, overshadowed by what's going on after this U.S. jobs report and in that Fed narrative that this very pointed one step back, two steps forward for risk response was foreshadowed. This week, we have a good bit of event risk and a good bit of news flow to inform this story and give us more color. So what we're going to do is have a look at that and see how this looks. The first will be minutes from September's FOMC meeting, where the Fed really convinced the markets that higher for longer is the operative message for Fed policy. Take a look here, and we can see that From that September 20th meeting, we get a surge in the 10-year yield, so much higher rates at the longer end, while the front end, the 2-year yield, pointedly idles. And we can see that what happens as this occurs is the numbers on the U.S. Treasury term premium that we have embedded in the 10-year benchmark note, this from data from the New York branch of the Fed, that not only turns positive for the first time in several years, it also appears to be surging right alongside long end yields and really explaining what's going on there. Now, what does this mean? This means that there is now a positive return associated with lending money over a longer period of time versus a shorter period of time. The time itself has become a driver of yields. And that frequently happens when people expect more uncertainty in the future. So they perceive a greater risk in lending over a 2-year time horizon versus a 10-year time horizon. That then demands a premium of return. Investors want to be compensated for that risk. And what we see here is now that seemingly showing up in markets and speaking to this uncertainty of a Fed that wants to hold now, but probably longer than markets were comfortable with, at a time when markets are pining for stimulus because of what's happening with global growth. Not surprisingly, if the Fed signals that they are not going to help at a time when their help is very much sought after, there is greater uncertainty about what all of this will mean. Hence what we're seeing on the screen here. And what's going on in global growth, as we were alluding to moments ago, is by no means encouraging. This is the catch-all global purchasing managers index data set from S&P Global and JP Morgan. As ever, it operates on a system where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below 50, the faster the contraction. We can see here manufacturing globally continues to be in contraction territory at a fairly steady clip, really going back over a year at this point. The main uplift for the global economy in the first half of the year was services. That uplift has crested and come undone already. And so here we are at 50.5 on the composite index globally, which essentially means we are but a hair away from neutral, i.e. standstill, and so not far at all from slipping into recession. That would be why the market seems to be pining for Fed support. And when the Fed signaled in September that that support is probably not coming soon, but might be delayed as they battle with inflation, the markets, understandably, given the consequences, took very acute notice. We can see here what has happened. So since September, we can see a furthering of this dynamic that shows us how much of a rate change we can expect and in which direction in the last 2 meetings of the year and thereafter over the course of next year. So between November 23 and December 24, so the end of next year, we are now looking at 91 basis points in rate cuts. That, of course, has been expanded as of today. It was a little bit lower, closer to about 80 basis points on Friday. We can see, likewise, where the Fed made its signal. Here's that marked there on the chart. And you can see when the Fed makes that signal, when it endorses that higher for longer view, the drift lower in rate cut expectations from somewhere between 2 and 1.75% back in June to now about 1%. So losing anywhere between 75 to 100 basis points in easing, as the Fed endorses it, markets clearly notice, and the S&P starts to move lower. We can see it here unambiguously. Not surprisingly, the dollar heads higher as well. Although it had been rising already as those rate cut expectations were fizzling, it gets another push. Now, what this seems to have done, and the reason why the markets appear to be perhaps starting to turn a corner, is because that tightening appears to have done the Fed's heavy lifting for it. The Fed need not necessarily raise rates if it can talk markets into higher interest rates rhetorically. And that's what seems to have happened. When the Fed came out in September, it didn't raise rates. As a matter of fact, we can see right here, front end rates didn't very much move. It's the longer end that rose, and so the markets readjusted to an environment where capital was going to cost more to borrow, looking out into the future. More than they were anticipating before that FOMC announcement. And so, not surprisingly, yields have gone up, and there's been a degree of tightening without the Fed having done anything. So what we can see here is since that September FOMC, inflation expectations have declined, as have rates expectations looking 12 months forward. We've slipped under 5% on the expectation in Fed funds futures for where rates will be in 12 months' time. But perhaps even more importantly, the 1-year USD inflation swap, the 2-year break-even rate, which is a measure of the inflation that's priced over a 2-year span into the bond market. They've moved pointedly lower since that FOMC announcement. And as a matter of fact, the 2-year break-even is now under the Fed's 2% inflation target, which is exactly, I would argue, what the Fed wants. They probably want it to keep going lower, off target, so that they have room to cut rates into that number rising and sort of coasting into a 2% number by the time we get to, let's say, this time next year, give or take. And so from the Fed's perspective, its job here is being done without them having to do anything. And so perhaps we have, in fact, reached a turning point. For this reason, it will be very, very interesting to watch what is going to be in these FOMC minutes. Because if the message seems to be that the Fed is as nimble as they are saying, if they are in fact data dependent and the main object of the game is getting inflation to 2%, and there isn't a commitment to the kind of orthodoxy that would say you need to have the unemployment rate go up for this to occur or for this to be right, if in fact it does comport with what the Fed says, that they are going to be responsive to these inflation expectations falling, and so rate cuts might be unlocked that way, well, then stocks get another leg. If the Fed minutes don't really push the narrative into any kind of a direction that contrasts or conflicts with what we've been watching over the past 48 hours and more of market action, really since Friday, then we have a situation where these moves probably have legs. But if the FOMC minutes strike the kind of hawkish tone that has the markets questioning whether the Fed is in fact feeling itself accomplished in what they were looking to do, well, then the situation might well turn. It's a similar story with September's U.S. CPI release. That's expected to see headline inflation come down a little bit from 3.7 to 3.6. Much of that is likely to come from energy. We can see here that leading into this number, energy, that yellow area with the yellow bars below zero, was a larger negative contributor to inflation, whereby it was actually pulling inflation down. That influence waned and became less negative in August and July as crude oil recovered. But crude oil has since turned lower and has erased a lot of those gains. So the waning influence of crude in this report might well give us slightly cooler headline inflation. The core number, though, and this is where the Fed's focus is, the one that excludes energy, excludes food, which tend to be volatile and where the Fed doesn't really have very much agency to have an impact because they're largely a function of global markets. Here, we continue to see disinflation for the 13th consecutive month in the expectations, down to 4.1%. And as ever, the main story is in the service sector. We can see here goods inflation has been squeezed down to next to nothing. It's really the service sector where inflation lives. If we continue to see progress here, in particular on the labor market components of it, well, then the market's perception of the Fed is probably correct. At least they'll feel that way for now. If, on the other hand, there is a sense that core inflation isn't falling or is stickier than would be necessary to keep this continuing to move forward, well, then we might have an issue. And again, as with the FOMC minutes, if the message is that we are somehow closer to the Fed cutting, then that's probably good for stocks, probably good for bonds, probably not great for the US dollar. Then a message that says that perhaps the markets have rushed to judgment and the Fed has more work to do, or at least might hold rates longer than is currently being baked in, well, then we have the risk-off scenario. And just to remind us, the Fed is focused on the labor market part of the service sector inflation puzzle, because as you can see here, while inflation itself has come down by multiple percentage points, whether you look at core or headline, the headline number has come down from 9 to 3.6, so it's fallen by more than half. The core number has come down from 6.6 to 4.1, so it's come down by more than 2%, nearly 3%. Whereas if we look at the employment cost index, ECI, it's down by less than 1%, from 5.1 to 4.5. That's because we still have a meaningful shortage of labor supply relative to demand. You can see that in the blue bars that you see there. And so what the Fed has been attempting to do is slow the economy such that you erode labor demand, reduce that shortfall, and unlock some of the inflation in the labor market, because, of course, the only way to reduce that demand and unravel that shortage is with layoffs. There has been, of course, a decline in job openings, which has helped to work down that shortfall from about 6 to about 3, cutting it in half over the course of the past year and a half. But you don't get inflation squeezed out of the labor market unless you have layoffs, because then and only then do you have wage agreement reset. And so some of the costs can be worked out of the labor side of the equation and inflation can come in. This is what the Fed is focused on. If they think this being successful requires them to hold rates longer and that the markets have jumped the gun, well, then a risk-off response beckons. As it stands, The first rate cut is already fully baked in for June. That's a month earlier than it was looking like even just a day ago. Certainly before NFP on Friday, there the expectations were for one cut no later than July, another one sometime in November, and then maybe a slight chance for a third in December. Now we're looking at three all the way priced in by December with a non-negligible 51% chance of a fourth. So rates have pointedly moved. We were about 4.6 on the Fed funds rate expectation by year-end 2024 before the jobs data. We're at about 4.45 now. So we've come down by about 15 basis points. With that in mind, there's lots of moving parts here. Obviously, the geopolitical situation in the Middle East complicates the reaction function for markets to all of this, and that's important to keep in mind. But so far, at least, the message has been the Fed's rhetorical abilities seem to have done its tightening for it. Rate cuts are coming sooner. Rate hikes are over. That means bonds have bottomed. Stocks as well. The dollar has topped in the relative near term. Now, this doesn't necessarily mean that we're off to the next decade-long move in any of these things in those directions. But for the past, let's call it since late July to now, the trend in stocks has been down. The trend in the dollar has been higher. Those things may be turning. The last bit that we are looking at here is going to be inflation data out of China. Here, the expectation is that the headline CPI number is going to be just a touch higher, 0.2 versus 0.1%, but certainly no less anemic. The PPI, the wholesale producer price index, seen getting a little bit less negative, up to negative 2.4% year on year. Not exactly the world's most encouraging picture, because as we look at GDP numbers, which really tell this story with a lot of clarity, as of the second quarter of this year, real GDP in China, that is GDP minus inflation, exceeded nominal GDP, which is not including that inflation adjustment. So if you think about it, if nominal GDP minus inflation is real GDP, and real GDP is above nominal, well then whatever you're subtracting from nominal GDP is negative. That's the only way you get nominal minus inflation is bigger than nominal, because then whatever you're subtracting for inflation is negative. And we can see here that the implied deflation economy-wide in China in the second quarter amounts to 1.5%, which is staggering. It is an absolute evaporation of demand. The pricing of power, or the pricing power in markets, comes from demand pulling on supply, and if that demand exceeds supply, the price goes up. If everything is on discount, that means the price of things is being slashed. That means there is no demand, and the price is being brought down to encourage it. The degree to which pricing power has evaporated and everything in China is now on discount because there is no demand, implied by a negative 1.5% inflation adjustment from real to nominal GDP, is speaking to a virtual collapse of demand in the world's second largest economy. That, of course, as we were alluding to earlier, is because China decided to reopen from post-COVID restrictions in December 2022, which was well over a year after catch-up growth crested in its main export markets, the US and the Eurozone. China opened nearly 18 months later. And what that means is that by the time it came back to market and said, hey, we're here, let's have us sell you some things, the supply chains for those economies were already very much being diversified away from China. And of course, since their growth recoveries had already crested and demand was cooling with the additional help of aggressive rate hikes driving it down, China never really saw demand for its export and by extension import side of things really rebuild. There was a brief pop that you can see here with domestic demand becoming reopened after COVID restrictions and people starting to move around and going to restaurants and going to work, taking the train, taking a plane ride. All of that gave us a pop in services. It crested already come March, and things have unraveled since. Now, Chinese economic data has tended to surprise below expectations, suggesting that investors' models and analysts' models are still rosier than reality has endorsed. There does seem to have been a bit of a improvement in the way that data has performed relative to forecasts since about the middle of July, but that seems like a mirage. Because just from that same time in late July up through now, we can see in this Bloomberg survey of GDP expectations, the forecasts themselves have been tuned darker. The forecasts themselves have been revised lower. So when you see here Chinese economic data doing better than expectations, again, still tending to undershoot them, still tending to be weaker, but less so by a lesser margin, that reprieve isn't because the data has been doing better. It's because the expectations have been lowered. The bar has been lowered. And so the likelihood is that this CPI data surprises lower looking at this. And in that environment, a longer Fed hold or any amount of Fed delay starts looking progressively scarier because the global recession risk starts looking more acute, with the world's second largest economy thus hampered. And so the recovery in stocks, the bounce in bonds might well be short-circuited here by the Fed, and the rise in stocks in particular, probably not the bonds, might be short-circuited by what's going on in China. But for now, it does seem like a major inflection point has been crossed across most of the global financial markets. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we look at the day's events on Wall Street and around the world and try to figure out what they mean and where things are heading next. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, opining on the news and insights portion of tastylive.com. As a matter of fact, a summary of this very analysis sits there already. And then offering some thoughts on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Good luck out there. See you tomorrow.